Wall Street is currently experiencing high volatility as well-known equities suffer sharp declines and the economy is showing signs of slowing down, which indicates more turmoil is still to come. Welcome to 360 Economist. Today, we've brought you various indicators and insights on the impending stock market meltdown. A dot-com-like investor enthusiasm, a widespread fear of missing out, and a spectacular increase in passive trading on Wall Street have all contributed to the unchecked expansion of the stock market bubble over the past few years. That huge bubble has now begun to burst, with some major names in technology falling first. Vikram Mansharamani, a distinguished author, emphasized in a recent interview, fighting financial bubbles before they burst is a sign that the present one is ready to blow, according to the creator of bustology. I think a bubble in passive investing has been developing and is about to fracture and explode. In several industries, flows have driven prices more so than fundamentals, and part of that is due to the enormous sums of money that are pouring into some of these indices, according to him. According to data from Bloomberg, more than half of all publicly listed equity index funds in the US presently follow a market-weighted index or portfolio. These funds have grown extraordinarily, largely as a result of their management style, which allows them to offer lower costs. However, Mansharamani claims that as the market becomes more dominated by capital flows and momentum-driven algorithms, the massive effect of the capacity of celebrity CEOs to sell the idea of a great new world in the form of enormous future gains has a significant impact on the public and has the ability to manipulate values. Elon Musk, the CEO of Tesla, serves as the analyst's primary example. These kinds of stories have driven stock prices higher, creating an unsustainable gap between the price at which investors value the company and tangible economic returns. Contrary to what the majority of investors today would have you believe, fundamentals still matter, and social media has simply served to accelerate this trend. Companies started to announce poorer than anticipated profits in the most recent quarter, which caused the market's attitude to a change and led to some shocking daily losses. For instance, Tesla stock has dropped by 25% in just a few days. The shares of Meta, the company that owns Facebook, fell by about 30% in a single day, resulting in the greatest ever recorded single-day decline in market value for a U.S. corporation. The significant decline reduced Meta's market value by more than $200 million, and CEO Mark Zuckerberg's personal wealth by over $30 billion. The Nasdaq Composite Index plunged even farther into correction territory, and the technology sector saw shockwaves that spread throughout the entire market. Although Mark Zuckerberg, the CEO of Meta, may be eager to drag everyone into an alternative reality, the large tech bubble was quickly deflated, according to Laura Hoy, an equities analyst at Hargreaves Lansdown. In 2022, many U.S. IT businesses have come under pressure as bullish investors become alarmed by an impending change in monetary policy, because rising interest rates would devalue the sector's high valuations and certainly trigger a stock market correction, which could result in shares with high valuations. The Nasdaq, which is primarily comprised of tech and growth firms, has been struck the hardest, shedding almost 10% and forecasting further losses, according to Kenneth Brew, a strategist at Societe Generale. The markets were caught off guard by Meta and other firms downgrading of their earning projections. In essence, large companies' soaring valuations in recent years have made them more vulnerable to investor whiplash, which results in losses of millions of dollars in a single trading day. Because of this, several other brands including Netflix, Twitter, Pinterest, and Spotify are experiencing sell-offs and sharp drops this week. The situation is not much better for the S&P 500, since the index has entered the correction zone and investment banks have been alerting clients that the drop is not yet done. A 50% decline in the S&P 500 is expected to bring valuations back to normal levels, according to several analysts who have issued this warning. All major indexes are now on the verge of entering a bear market after a week-long sell-off. If corporate profits keep underwhelming at the same time that the Federal Reserve starts hiking interest rates, they will be quickly pushed over the edge. The most speculative sectors of the market have been struck the hardest, Morgan Stanley's Michael Wilson noted, adding that it's too early to be bullish and warning that the S&P 500 might suffer another wave of double-digit losses. It includes phrases like Peloton crashing 75%. Winter has arrived, and for many individual stocks, the damage underneath the surface has been significant, if not disastrous, Wilson continued. Given the gravity of these economic concerns and the political will to act, the Fed is committed to battling inflation and is not expected to change its stance very soon. The sudden policy change that is set to plunge Wall Street into disarray has also drawn the serious concerns of John Hussman, president of Hussman Investment Trust. Hussman, who has predicted multiple stock market catastrophes in the past, agrees that the current situation is worse than it was during earlier periods of excessive speculation. He contends that the Federal Reserve is too culpable for the impending financial catastrophe that would result from the concurrent deflation of many toxic bubbles. The most magnificent bubble we have ever seen, according to him, has been created as a result of the central bank's policies, which have injected money into the U.S. economy. When patterns start to return to their historic norms, the market is virtually positioned for limited returns over the next 10 years, and Hussman predicted that the S&P 500 will decline by at least 70%. Investors should also anticipate not only poor profits, but also increased potential risk in a grossly overpriced market. The experts emphasized, "I've never witnessed speculators with such conviction that the good times would never stop, or such faith in the Federal Reserve to make it. So I'm fairly clear that this is a delusion, but I am less certain about how long that delusion may last." We are left with no choice but to deal with the reality of Fed-induced speculation until its disastrous effects are inevitable. The Federal Reserve has created an all-asset speculative bubble by persistently depriving investors of risk-free return, which, according to our estimates, will only offer investors return-free risk. This is a real problem for the Fed because it has completely abandoned any semblance of a systematic policy framework in favor of one that is purely discretionary, he said. The U.S. analyst Harry Dent is going to backfire given that this unprecedented level of excess liquidity has made the economy fundamentally weaker, and many traders are only now realizing that many companies with sky-high stock prices have also taken on more debt. According to a study by Dent, about 30% of U.S. public corporations are so-called zombie companies because they are unable to pay their debts. He warned us that a big reckoning is about to take place. Dent echoed his earlier warning, stating that this bubble must burst and that it would be the greatest crash in history. He said it will be such a hit to investors that they will not buy in next time. They will not leap back in and purchase the dip. They'll say that something is amiss. According to the Economist and Peripheral, who correctly forecast the 2007-2008 financial crisis in the book, The Impending First International Debt Crisis, debt levels are a crucial sign of a significant market turn. Debt implies market volatility and is an indication of fundamental economic difficulties. According to Ms. Peripheral, we know that investors' concerns about whether assets were really worth what they claim to be worth, and if the idea that stock prices would rise indefinitely could be sustained, led to the great financial crisis, indicating that excessive funds had been invested in speculative betting. When major stocks sink, a ripple effect quickly spreads throughout the market, indicating that the bubble is fighting to hold. This is indicated by the rapid gains and losses of some shares. A catastrophe of catastrophic proportions is the only probable result of this frenzied rally. So ready yourselves for a lot of suffering and start planning before it is too late. This financial asset bubble is worldwide. It involves stocks, bonds, housing, and many other assets given its unsuitability.